Now, despite more than 5 percentage points in interest rate hikes, the Federal Reserve has seen little evidence of a downturn in U.S. demand. Central banks need to consider the effects of their policies on the supply side of the economy, an idea that has recently gained traction among policymakers and Fed observers as well. Now, the result is that excessively high interest rates may impede efforts to combat inflation by reducing the positive effects of the newly available increased supply. Demand, that's the primary target of monetary policy, which is a fundamental tenet of macroeconomics. If interest rates are raised, borrowing costs rise as well, and consumer spending that decreases, which reduces inflation. And the harsh remedy for excessive demand and price inflation is a recession. The idea was presented in a seminal article at last month's Jackson Hole conference. An increase in the interest rates impacts financing the circumstances and the desire for risk, hence limiting the supply side of the economy by discouraging innovation. The importance of supply as a supporting element to demand was emphasized by Powell himself at the meeting. Coming Wednesday, when the Fed announces its latest rate decision and officials revise predictions for the benchmark rate, Powell will have the chance to explain the two dynamics. Economists are expecting no change in the rates this time, but they are planning for another increase later in the year. Strong economic growth that has increased labor force participation, alleviated labor shortage and slowed pay growth in recent months. WION is now available in your country. Download the app now. Get all the news on the move.